The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Hello, I'm Brian Akers, certified financial planner practitioner from Akers Financial Group, and we welcome you to Winning in Retirement. Today I have with me Mark DiOrio, Chief Investment Officer at Brookstone Capital Management. Mark has been in the industry for more than 20 years. He has been featured in Investment Business Daily and quoted in the Wall Street Journal. And we work with him as one of their portfolio managers. And he's also someone that I actually call my friend. Good morning, Mark. How are you doing today?
Good morning, Brian. Happy to be here.
Am I your friend too, Mark?
Definitely.
Oh, cool.
We've been through many battles already, many markets already.
It's pretty crazy the way the markets go. Now, today's show, what we're going to do is this. We're calling it Your Investment Portfolio. No matter what stage of life you're in, what happens is this. You need to look at your portfolio and understand what is going on. And so we invited Mark DiOrio from Brookstone Capital Management, which we use for money management with our clients or for our clients. And we've invited him to talk about this. We're also going to talk about designing your retirement portfolio. We're also going to talk about core plus satellite approach to investing. So as we talk about your investment portfolio, what we're going to do today is really just try to talk money, talk investments, and see what people should be thinking when they're trying to go through their investments. All right, Mark, you ready to go?
Let's do it.
All right. So market review. What do you think about the stock market so far here in 2022?
Well, I think it's really important anytime you look at the market to realize where the market has traveled. And so the first quarter of 2022 was really a tough quarter for investors. All major asset classes of stocks and bonds generally were lower, and only commodity prices were higher. And so much of the challenge in financial markets can be attributed to inflation. So I'm sure that doesn't surprise anyone. And inflation continues to run hot. And really what that means is that the Federal Reserve, the central bank of the United States, really has a decision to make of whether they should raise interest rates or lower interest rates. And so if they're raising interest rates, they're trying to slow down inflation. And if they're lowering interest rates, they're trying to stoke growth and inflation for the economy. In this case, they're really looking at slowing down inflation. And so they're on the path of raising interest rates. And the market has already responded, the bond market, by yields or interest rates rising in anticipation. So if you're to go back even 6 months ago, we've seen a big change in what interest rates look like. And in particular, the short-term interest rates, which the Federal Reserve controls, they've just started to move interest rates, but already the 1-year and 2-year and 3-year rates are much higher than they were because the market moves in anticipation of those rates. So short-term rates are closer to 2%. Now, the good news is you may be starting to make money on those short-term investment vehicles, a little bit of interest that haven't been paying very much over the last several years. But the challenge for financial assets is what happens is that lowers the present value of future cash flows, so most financial assets will decline. And that's what we saw. And we're also expecting this to create a slowdown in growth overall in the economy. Now, that's not necessarily mean that we're going to go into a recession where that's 2 consecutive quarters of negative economic growth. This just means it looks like a slowdown, which is really what the Federal Reserve wants to have happen. We were obviously very quick out of the gates with aggregate demand, with the reopening after the pandemic, and that created this demand and supply mismatch. And you may have heard there's been supply chain issues, but that's because part of it was these after effects from the pandemic was shutting down businesses and trade and really this disjointed kind of economic environment that we've had. And then all of a sudden we reopened and consumers had put off demand, but then surged. In addition, there's stimulus payments that came through. Well, we're about on the other side of that. In other words, the stimulus money has all been spent. Personal savings rates are already back to pre-pandemic levels. So there isn't really that pent-up demand that there was. So we're at the tail end of this. At the same time, we think the supply disruption is going to smooth out here as we move on into later on in 2022.
All right. Did you catch your breath yet?
Well, I would add, and I didn't want to leave this out as I was catching my breath, was really a lot of some of the uncertainty in markets and inflation, of course, is related to geopolitical events and the price of oil.
Right.
And so the price of oil is back to where it was in 2011 to 2014, if you can believe that, around that $100 a barrel. It's for 7 years, it was below that level. And what had happened was oil production had really slowed. Production in the sense that a lot of the oil rigs kind of started to turn off and really turned off during the pandemic. And so now as prices have risen, kind of the old saying with commodity prices is what reverses high prices? Well, it's high prices. In other words, it does two things. It slows demand, and then it also incentivizes producers to produce more. So what we're seeing now, which was one of our concerns previously, was with oil, when it was around $70 and $80, we didn't see an uptick in rigs operating to produce more oil. Now, above that $100 level, we see rigs getting back online, and we expect production to shortly follow. And really, we're still below the level of oil rigs in use that we were at in 2011 to 2014 when prices were at this level. So we have a long way to go, and I think there's a lot of production that can get ramped up here. It's just a matter of kind of a timing arbitrage, if you will. How long does it take us to get that going? And of course, with geopolitical events, I think the urgency is now, and so that's really giving further incentive or reason to ramp up production here.
Yeah, when I think about inflation, would you say inflation is caused entirely by the oil price change? What would you say about the inflation?
It's really due to aggregate demand taking on a level that's above supply. And so
that's across the board. That's across every product, everything out there.
Correct. And that's why you see it in some areas, and that's why you saw it in automobiles, for example. Well, you didn't have supply get back online, but there remained demand, and kind of as the pandemic slowed sales naturally, just because there wasn't a lot of activity going on. When it reopened, you had this surge in demand just because people and consumers had put off certain purchases, but supply didn't get online. So you can have these mismatches where you have this supply disruption, but we would say sustainable inflation is really due to excess demand. They call it a shift in the demand curve for, if you remember, economics back in either if you took it in high school or college or graduate school. That's what they would say. And so today we think that this is more supply disruption based as opposed to a major jump in aggregate demand. And oil is an interesting example because the U.S. economy is using less and less oil. We're just becoming more and more efficient. And so oil doesn't represent nearly the size that it did, let's say, in the 1970s, size of the economy as it did in the 1970s, so where it had really big impact on inflation. Today, it does have inflation. Nobody likes to pay more at the pump. So it is impacting consumers, but it's not really taking the same share of income that it did in the 70s. Wow. So it's part of this issue, but I don't think it has as high a correlation as it used to.
Now, when I think about inflation and interest rates, the Federal Reserve has only raised the federal rate by only 1/4 point so far. So why are they waiting so long, and will they actually raise the federal rate?
So the historic trend has been the Federal Reserve will raise rates until the short-term rate. So what they raise is short-term overnight money, what banks lend to each other in the overnight market. So they set that rate, and every other kind of maturity takes its cue from that rate. So if it's a 2-year treasury, a 10-year treasury, a 30-year treasury, kind of cues off that short-term rate. Historically, the Federal Reserve raises interest rates so that the short-term rate equals the 2-year rate. The 2-year rate today is about 2.5%.
Right.
And so you're right. It's a long way from that 2-year rate. And so it's implying that there'd be a lot of interest rate rises. And I think the Federal Reserve is correct in trying to take this slowly. In other words, if they raise rates too fast, it could kind of shock the economy and really surprise the economy too much. Housing would be a good example where you have a very strong housing market, but if rates get too high, you're going to discourage a lot of consumers, and you'll just have kind of this buyer strike because prices have risen, but now the cost of money has risen much quicker than anyone anticipated, and that, of course, will trickle down to impacting banks and other lenders and so forth and so on. So I think the Federal Reserve is right by going slow, but telling the market that they're going to raise interest rates and that their primary objective is to get inflation under control. Now, the Fed has a dual mandate, and that's often what you might hear, it's to maintain stable prices over time, so that's manage inflation. And then the other is to promote full employment. Well, in this market, the positive, or kind of the silver lining, even though we've had all these headwinds this year, a lot of volatility, is that the employment picture is awfully strong. It's about as big as you're going to see in terms of job openings that are not filled at the moment. And so we see more wage inflation, or prices for workers rising. And that's actually good that it's trickling down to the employees, because if you had inflation without wage inflation, then consumers would really be suffering. But that's not the case. It's starting to trickle down into wages. And so those are seeing pretty good bumps overall. But the point is, you're at maximum employment. It's below 4% unemployment, and still many, many job openings. If we're going to go into a recession, or if the economy was going to roll over here, you would see job openings decline and unemployment rates start to rise. We just don't see that yet. So I don't want to be premature in calling all these problems are going to lead to, very catastrophic events, or, very bad economy, because of the jobs market is so strong.
Yeah, absolutely. So today on Winning in Retirement, what we're doing is talking to Mark DiOrio. Mark DiOrio is the Chief Financial Officer from Brookstone Capital Management, which is a third-party money manager that we work with at Akers Financial Group, and they help us with managing some of the money for our clients. Now, Akers Financial Group, the best part of retirement for our clients is when they get their time back, where they decide how to use it. Before retirement, your time's all tied up with other commitments, like mainly your job. A lot of that goes away in retirement. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. You just go to our website at akersfinancialgroup.com. Scroll down the schedule a meeting section and let us know that you'd like to schedule a time for a free consultation with one of our team of advisors. That's akersfinancialgroup.com is the website, where you can give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll call you on Monday to schedule your free in-person or Zoom meeting. Go to akersfinancialgroup.com or give us a call at 833-946-7384 to start planning for your retirement now. There are investment opportunities now. We'll talk about where to find them in the second quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back. I'm Brian Akers, Certified Financial Planner Practitioner from Akers Financial Group. And here with me today is Mark DiOrio, Chief Investment Officer at Brookstone Capital Management. He's been in the industry over 20 years, and I've known him for a while now. Now, Mark, welcome back to the second quarter of the show. You good?
Let's do it, Brian.
All right. Now, you're from Chicago, and you're calling in today from Chicago. That's correct?
That is correct.
And what's your favorite sports teams out there in Chicago?
The Bears. It's because Cubs fans and Sox fans typically don't get along.
Yeah.
The good answer is you're either a Bears fan or a Blackhawks fan.
Okay. But in baseball, you like both teams equally, correct?
Correct.
Yeah. All right. So at Akers Financial Group, we meet with our clients, and then we work on ways to plan and implement their portfolios to the future. So we designed this show today called Your Investment Portfolio. It's like, how do you manage your money? What do you do? What do you think about? And what we're doing so far is talking about the market conditions, and then we're going to build on this to talk about how you really need to think when it comes to building your investment portfolio. At Akers Financial Group, we use Brookstone Capital Management to help us with managing money for a fee. So it's a fee-based financial planning where it's actively managed, and Mark DiOrio is one of those managers that we use. Now, Mark, the second quarter here, the first question is this, is what are the investment opportunities that are out there now based on all the conditions you've mentioned in the first quarter?
Sure, and I think I'll go back to where I started the first quarter, which was it's important to remember where markets have been. So this first quarter has been really tough for investors. Both stocks and bonds broadly declined, and that's not typical. Usually you'll get bonds performing pretty well, hold up on the portfolio when stocks are declining, and it could be vice versa. And so now we have stocks and bonds declining. But going into this year, our baseline assumption was that the market was going to experience a correction. And a correction, you can define it as a decline of about between 10 and 20% from its recent high. A decline of 5% to 10% would be called a pullback, and a decline of 20% or more would be considered a bear market. And so we thought we'd get into a normal correction this year, and the average correction was 14%, a negative 14%. So this happens about once every 18 months, and it can go a little bit longer, a little bit shorter in between those declines, but it's not. Or I should say, it's actually normal for markets to go through corrections. And so when we see that, we don't get scared. We think that's an area of opportunity because markets have declined. So the markets declined very close to that average negative 14%. It dropped 13% before a late rally in March to kind of bring it back into the single digits. But that was a pretty good decline that said, okay, the market has kind of left any overvaluation. It's started to reduce to levels that we find pretty attractive, and you never know where the market stops and starts to head higher. But broadly speaking, we'd say tech stocks or growth stocks have really been hit pretty hard this quarter, and we think they'll still have a little bit of challenges as the Federal Reserve still is talking about raising rates to combat inflation. So until inflation peaks and starts to head lower, we think a good area continues to be value stocks. Value stocks do better during an inflationary environment than growth stocks, and that's what we've seen through the first quarter. And so we've broadly been positive on value, and in particular, and I know, Brian, you and I have spoke about it, and I know you allocate to this area, but one of our favorite areas is focusing on high-quality dividend-paying stocks. They're almost a subset or an asset class themselves because they're high-quality companies that kick off a current yield in the form of a dividend payment. And the dividend isn't determined by the market or the market's daily movements. It's determined by how well the company's doing, and the board of directors determine that, okay, we can pay a percent of the profits out to our shareholders. That's a pretty good value proposition. And in today's world, they're actually broadly, dividend stocks are paying out more as a percent in yield than bonds are paying in yield. So that's a very good area. In addition, you get the potential for capital appreciation over time of the value of the stock or the value of the company.
Yeah, I totally agree that dividends really are a way to basically soften the downturns because you're getting paid to hold a stock, and also a great place when there's a flight to quality when there are corrections. Now, you had mentioned a little bit about having a correction earlier this year, and there is a possibility of more correcting throughout this year?
I'm glad you brought that up. We've looked at the last couple of cycles of when volatility in the marketplace rises. In 2020, when the pandemic started, you had a very steep decline of about 30% in the market over the first quarter, very short window, and then all of a sudden this V-shaped rally back higher. But the other periods in 2018 and 2015 and 2016, for those not always following every movement in the markets, we are. But I reference those periods because they stand out in my mind because there's some similarities here. In 2018, the Federal Reserve was raising interest rates, and coming into 2018, the market was really overbought, and so we've had this big rally. And so similar to 2018, where we've had kind of this first sell-off, and then it rallies back, and then you have a second kind of echo, if you will, correction, just to make sure it cleanses all the any overvaluation or speculation or any of the areas that really needs to kind of reset before it can move higher. So we do think there's potential and are definitely aware that, yeah, you could have a rally back here and then the market kind of what's called retest the lows or kind of have another correction before resetting and being ready to move higher. So there is a tendency for the market not just to jump, turn on a dime, but given the scenario and given the kind of the inflation and geopolitical challenges, the market could gyrate back and forth. And that's why I've kind of talked about you don't have to make a dashing investment call right now or allocation or prediction right now. What you can do is say, look, the market, one day you see a big rally, the next day a big sell-off, and then it reverses and it continues to go in this kind of jagged pattern, and maybe it has a jagged upward pattern, and then maybe a little bit more volatility. So later in the year before heading higher. So I do want to build portfolios with that in mind, knowing, okay, we're going to see some volatility this year. There's no real way around it as the interest rate picture changes, and we try to really normalize policies that were in place during the height of the pandemic and the shutdowns.
Right. So what I'm hearing you say is that there are opportunities in the market, and there's like a first sell-off that we've already had, and there probably is a second sell-off coming this year. You've also mentioned the first quarter about the possibilities of recession, which would be more than just a sell-off, I believe, and then that would give us other opportunities to buy into different areas in the market.
Correct. So if the market really starts to turn or the economy starts to weaken much quicker, then you could see a recession. But I don't think that's the overall objective of the Federal Reserve. They just want to slow down inflation, not really, tear down the economy after there was so much work both on the monetary and fiscal stimulus side to get through the pandemic. That I think they just want to slow down inflation. And once they see that, they're going to continue to go slow or a moderate pace with interest rate rises. But if that does occur, more and more opportunities present themselves. So being in the business, as you mentioned, over 2 decades, what I can tell you is a lot of future outperformance, if not all of it, comes with decisions you make while markets are declining and all the news is bad. This is really where the opportunities are created versus when the market's trending higher. So these are the times to look at the portfolios, make any adjustments, position for kind of better days ahead. And understand that may not be tomorrow, but we're getting there. This is kind of a process that markets go through. They've gone through them time and time again. I mentioned 2018, 2015, 2016 had a very similar pattern where you had, and this is when Russia and Saudi Arabia were actually battling and trying to undercut each other on price, a little bit of the opposite of what's happening with oil now, where they were trying to overproduce oil and drive prices lower. So 2015, you had a sell-off in the fall, and then in early 2016, you kind of had that second kind of sell-off after a little bit of a rally in between. And then the market headed higher for a couple of years then after that.
Absolutely. I was thinking a tax law caused some of that in the United States. I was thinking that with so much going on around the world, that's definitely a part of the subject would be, should we look at opportunities in international investing?
International is very cheap relative to the United States, but the market is really telling us that the U.S. is still the number one destination for capital. It is the biggest, most liquid markets in the world. And so that's where big pools of capital can go to allocate. Now, this year, for example, in 2022, with commodities rallying, Latin America and other commodity-based countries and economies have done very well, actually, relative to the U.S. But that's kind of a small portion of the portfolio that you can allocate to. So there are opportunities that present themselves if you want to get exposure to different areas. So it's important to remember, not all economies are the same. Some are service-built, some are industrial built, some are technology-driven, and some are commodity-driven. And so whenever those areas are performing well, those markets do well. So you got a couple of factors here internationally when you're looking at it. You can go broad international, but you can also go a little bit finer tuned and find those areas internationally that would perform well in this type of environment.
Yeah, some of the keys to diversification is to really consider the areas that seem doing like they're doing the worst. It's almost like when there's blood in the streets, you really need to put some cash to work. So what we've been talking about with Mark DiOrio is truly about your investment portfolio. We've talked about the market and what's going on in the market and the conditions are there. And then this quarter, the second quarter, we've been talking about some opportunities that are out there and some thoughts that are happening as we're thinking about the future that has us thinking about our money this year. Now, what happens is this. At Akers Financial Group, we are a local and independent, and we don't report to a big company on Wall Street or a big company in Iowa. We report to you. We have offices in Forest Hill and Lutherville, and we do have clients all around the country and even around the world. It's so easy to begin winning in retirement. You can just give us a call to have a free consultation with one of our team of advisors by calling us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We will call you back on Monday to schedule your free in-person or Zoom meeting. Go ahead to AkersFinancialGroup.com or call us at 833-946-7384 to start planning for your retirement now. Do you have a core investment philosophy? We will talk about this in the second half.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Just like the announcer welcomed you back, I'm welcoming you back and welcoming you back to Winning in Retirement. This is Brian Akers, a certified financial planner. I'm president and founder of Akers Financial Group. Here today on our show is Mark DiOrio, Chief Investment Officer at Brookstone Capital Management. He's been in the industry over 20 years. Brookstone Capital Management is out of Chicago, and I believe you guys manage over $7 billion or $8 billion. What's the number now?
Over $8 billion.
$8 billion. Wow, congratulations. That's an incredible amount of money to be responsible for.
Oh, definitely. Yeah, it's been a great ride. We've really, our assets have really grown over the last few years, and a lot of it has to do with our portfolio construction methodologies and how we've approached these challenging markets.
Yeah, absolutely. And I know one key piece is about core investing. And so one of the things I wanted to mention here is this. Today's show is called Your Investment Portfolio, and what we're going to be recommending over the second half here is what is your core investment portfolio? What is your core philosophy when it comes to your money? Do you have one? Most people driving around right now probably don't have a core when it comes to how you're going to invest your money. You sort of might just check a box. You might just listen to the rep that sold you the 401k at work. We are questioning your thought process. We want you to understand what you own and understand the thoughts behind having a core portfolio in your investments. All right, Mark, what's your thoughts on a core portfolio?
Well, I'm glad you brought this up, Brian, because over my career, what I've seen is maybe 70% of clients that come in to work with a financial advisor have a mismatch between what they may say in terms of their risk profile and what they're looking for and their actual portfolio. And so having a core philosophy or a core portion of the portfolio that really acts as your anchor is really important, and to get that in line with your overall risk profile. And so from a portfolio philosophy perspective, it goes back to traditional portfolio theory, which is generally saying you should diversify your assets among different asset classes, and an asset class is a set of similar securities. So stocks are an asset class, bonds are an asset class, and then from there, the way the financial markets work is you have sub-asset classes, so you can really expand this opportunity set. So large cap and small cap stocks, for example, treasury bonds and investment grade corporate bonds would be an idea of sub-asset classes. Now, how you combine those in a diversified, risk-appropriate manner is really the art and science of portfolio construction. So what we want to do is make sure you have broad portfolio diversification among the different asset classes, consistent with your risk profile. That's a combination of your ability and willingness to assume risk or risk tolerance. And that's where I think an advisor plays and Brian, please chime in, a big role of aligning that core portfolio.
Yeah, I'm amazed when someone walks in the door and it's the first time you're meeting them. They talk about their thoughts on money, and then they bring their statements out, and you look at those, and I said, well, this looks a little bit different than the way you described your thoughts on money. And we sort of have to break down to a point of what's your goals with your money? What is the purpose of the money you have in front of you? One of the cases a few weeks ago was a client that simply got inheritance 10 years ago, and they left it in the same stocks for their 90-year-old mother for them. So they spent the last 10 years in some stocks that have been around a tremendously long time that have not grown much at all. And so examining where your money is a key component of financial planning. Understanding your goals, and then also designing what is that core piece that was going to be our fundamental piece that we hold through the good and the bad of the market, where we're not going to be jumping in and out and trying to do market timing. A core is something that we're going to count on, rely on to help produce for us. At Akers Financial Group, we don't believe in owning bonds individually, or we have some individual bonds, but not in bond funds, because the interest rate hikes will greatly affect your principal, and you might possibly lose as interest rates rise throughout the next year. The stock side, we believe in diversification, and that's why we have Mark DiOrio at Brookstone Capital Management, and he has a number of core portfolios that we use. What are some examples of those, Mark?
Sure. There's one series that we call the Smart Beta Portfolio Series, which again is a fundamental process of a core portfolio of providing diversification. And that diversification generally comes in the terms of, as I was mentioning, asset classes, asset allocation to really drive fundamental long-term portfolio results that we can quantify and give you an estimate of here's your expected return, here's your expected risk, given all of market history as an input. And then you can do that for different mixes, and you can really design the correct core portfolio for an individual to get that and calibrate that portfolio design. So Smart Beta, for example, is using a process of not just using the broad market indexes that are market cap weighted and so forth. It's a way to improve upon that by identifying, for certain clients, identifying the lowest volatility stocks in the marketplace. And what we found was actually if you have a basket of the lowest volatility stocks, it actually performs slightly higher than the overall market with less risk. Why? Because those are stocks that have proven business models, are consistent, are profitable, and there's just not that much question over the valuation of those companies over time. And those are some of the more common names that you may have heard of. But why investors have liked it is because they want to participate in the long-term benefits of the equity markets, but with less volatility. And so on the bond side of the portfolio, what we do is actually build something called the bond ladder, and use investment grade bonds. And so you minimize what's called interest rate risk and credit risk by taking that approach. And so this really gives us a lower volatility way to address core stocks and core bond holdings. And again, that's calibrated the mix between stocks and bonds consistent with your risk profile.
Right. When I think about core, and what I like everyone to think about when it comes to core is this. Think about an apple. What's the core of the apple? Well, it's the seed. And so the core of your investment is the seed for your growth. It's the seed for this money that's going to be there throughout your life. So you need your money to grow to meet your needs of the future. And so when you talk about core, this has to be a fundamental diversified piece. Your core cannot be in one stock or one industry or one currency. It has to be diversified. What are your thoughts, Mark?
Well, I think this is a very good point. A lot of people think of there's an old kind of saw that you buy certain stocks and you hold them forever. But what we found is that there's certain stocks today that are doing well, that if you go back 20 years, weren't doing very well for many, many years, and vice versa. And so they go in and out of favor. And what you'll find is that most individual stocks underperform the overall market, and that only very few drive those market returns over time. So this is a very important point, and why you say this is why you diversify, to get the benefits of the overall market. And you never know where benefits are going to accrue, because the stock market isn't necessarily always rational. It can be irrational. It can drive prices much higher than you'd expect and much lower than you'd expect at certain periods of time. So for sure, the diversified approach allows us to quantify those expectations and give us a higher confidence of achieving those expected returns.
Absolutely. And so what's also happened over the years is that Akers Financial Group has worked alongside Mark DiOrio and Brookstone Capital Management to design the AFG Select portfolios, which are portfolios designed in a way that at Akers Financial Group, we use these as our core, along with some other ideas that Mark DiOrio has mentioned and other ones he hasn't mentioned yet. But we call it the AFG Select. We do have an income portfolio, a moderate, and a moderate aggressive. Those portfolios are broadly diversified across the U.S. and international. We do have commodities and gold, and we try to have some focus on dividends and buyback type investments where we try to go for growth, value, and even momentum styles all in one place. So that's some of the core that we've been using. What are some other core examples at Brookstone Capital Management?
Sure. We have different model series that'll provide or assume different types of approaches or asset classes. One of those is our Select series, which combines a strategic component and a tactical component. And in the tactical, that's more short-term, kind of adjusting the portfolio. So if you think of strategy and tactics being a little bit different. So we combine those two ideas, but on the tactical side, what we've done, given this marketplace and given the challenges with both traditional stocks and bonds in this market, is add a few things that you don't typically see in portfolios, which is something called market neutral investing or merger arbitrage investing, or one of my favorites is called hedged equity, which is basically you're getting about a moderate risk profile out of a hedged equity strategy. So it's a moderate risk profile, moderate return profile, but you're doing it without bonds. So you don't have the bond risk. So for those that might be concerned about rising interest rates and maybe the bonds declining, here you don't have that risk. So you can maintain exposure to the equity markets and enjoy the benefits over time of the equity of participating in the equity markets, but with a constant hedge on there, which reduces your downside volatility. And investors have really enjoyed that, I think, because they want to be part of the equity markets, but again, assume that with less volatility. And I would say when I look at your portfolios, Brian, they're very sophisticated core portfolios that do include different components that many portfolios and many advisors don't include.
It's our goal to build a portfolio that takes less risk in the market because these core ones are designed towards people that are heading into the retirement years. And then we add on satellite, which is our big topic for the fourth quarter, into the mix. But the core portfolio to me is portfolios that we are going to count on. There are changes that are made. It could be made on a quarterly basis or even more often, depending on what's going on in the market. It's been a crazy time the last few months. All right, so Mark, this idea of core we've been talking about, it's like the apple where it has the seed to the growth you need for your future. So this core investing is just something you guys need to think about, especially when you're talking about your investment portfolio. Do you have a core? Do you have something that is there, built and diversified based on your risk tolerance, tied to your personal timeline? Now, Akers Financial Group, we want in your retirement, the biggest worry of that day should be where you're going to drink your morning cup of coffee, where every day seems like a Saturday, free of stress. Your retirement income investments are taken care of by the team of advisors at Akers Financial Group. If this is the future you want, it's not too late. It's so easy to begin winning in retirement. Meet with one of our team of advisors on a free meeting with you and for your retirement needs. Go ahead and give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We will call you on Monday to schedule you a free in-person or Zoom meeting. Go ahead to our website at akersfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. What spices are a part of your investments? We will talk about this in the fourth quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back. I'm Brian Akers, certified financial planner practitioner from Akers Financial Group. Here with me today is Mark DiOrio, a chief investment officer from Brookstone Capital Management. We work with them to help design and actively manage the investments we have for our clients. They are a third-party money manager out of Chicago, and this show has been recorded and will be available online at our website, akersfinancialgroup.com. You go there, hit the radio tab, and you can hear this show again if you like. You can also go to our podcast on Spotify, Winning in Retirement. Now, when we're talking about financial planning and we're talking about investments, we think about your investment portfolio. And you should be thinking about your investment portfolio. And we invited Mark DiOrio to our show today to truly talk about investing in these kind of days, these kind of times. Now, just to throw things off a bit, the question for the fourth quarter is this, Mark. What spices are a part of your investments? And my first question to you is, are you from Chicago? So what are the spices that you have to have in Chicago?
Well, I know most people probably think of deep dish pizza, which is a high quality export of Chicago's, but another one is Italian beef. And so you can get it with regular peppers or giardiniera or hot giardiniera, but the spices in the Italian beef are excellent. So there's a couple of different ones that pop out, but if you're in Chicago, you should definitely try Portillo's.
Portillo's?
And their Italian beef. Yes,
oh, yeah.
Definitely.
I think I had a hot dog there.
You could have a hot dog there, and the funny thing about that is hopefully you didn't have it with ketchup, because they will look at you like you don't know what you're doing. That is not proper.
I went straight Chicago dog with everything, all the stuff they add.
Yeah.
The green part of the relish is just the weirdest green I've ever seen. Now, in Maryland, when we think about spice, we have our Old Bay. Old Bay is a spice. Have you ever heard or tasted Old Bay?
I don't know if I have.
Well, next time you're in Maryland, we'll make sure you try out Old Bay. Now, the idea of talking about spice is this. If you have a core portfolio and you want to spice up your investments, we can add salt and pepper, or you can start adding more hot sauce to it, or you can have the ultimate spice, which is Old Bay, of course. But what happens is this. We call this satellite investing. So you have your core portfolio, and then you build satellite investments around that core portfolio. Yes, around. The satellite will move around. All right, so what kind of satellites would you recommend or want people to think about when it comes to adding on to core portfolios?
Yeah, and I just want to hit on how important this portfolio construction framework is. Having that core portfolio that we talked about in the third quarter allows you the flexibility in your portfolio to have a few satellites or opportunities that really make sense for maybe more defense, more income being generated off the portfolio for income ideas, or more growth-related activities. And it really helps you position size. That's a term I don't hear a lot of in the industry. I know we talk about it, Brian, about thoughtful portfolio construction. And if you have an idea, okay, well, you don't put everything in that idea. You put the appropriate size of the portfolio in there, and the satellite really gives you an idea of, okay, that's where it belongs. And so your core portfolio is participating in the markets and fully diversified, but here might be an opportunity that either the market presents or that you prefer. So if you want to invest in tech stocks, or a popular one is disruptive innovation stocks. And what is disruptive innovation? Well, it's looking at those companies that could be big and are really going to be impactful in 5 years. So that could be in genomics, for example, taking the handoff from pharmaceuticals. It could be in artificial intelligence type companies that really aren't mature yet. Revenue is just getting going, but they will have a big or an outsized impact in a number of years. And so you never know when that's going to be hot in the marketplace, but you know that it's coming. And you just want to have a position in there to participate. And if you put all your money in there, for example, and say, oh, it's the next thing, well, what happens is it's way too volatile to really be a comprehensive portfolio. But if you put a piece of your portfolio in there, it's more likely that you're going to be able to maintain that position and then participate in that wave.
Yeah, I was thinking about disruptive technology. Over the last 12 months, it's actually been one of those leading categories that have come down. And the reason it's come down is because of taking the profits of it being more rightly aligned with its earnings and price than it was just a year ago.
Yeah, correct, and it's very volatile. So, when I look at areas and they're very volatile, I would say that's a satellite allocation, and you shouldn't be surprised by the volatility. It's that we know it is, and so you position size it, put it in the satellite. On the other side, you can look at some income opportunities that may make sense if you want more income being generated from your portfolio, but they may be a little bit different than the traditional stocks and bonds. Something that we've looked at is strategies that use covered call writing, and I don't want to get into the weeds with options, but this is a very straightforward strategy. It doesn't use leverage or it's not exotic. It's basically you sell options to generate income on a standard portfolio or on a standard index that you'd invest in, and then you collect those premiums, it's called, and it generates income in the well above where bonds are at, for example. So that's a unique source of income. So what you're trying to do with those satellite allocations is find those unique opportunities. And I know I've looked at your portfolios, Brian, and really had a good first quarter of what you added into that satellite to complement that core portfolio. And I think it makes so much sense, especially how challenging markets are. And maybe you could, add a little bit on your thoughtful design of that portfolio.
Yeah, we put together a diversifier, which is a way to diversify from the core, sort of a defensive measure. And what we're trying to do there is we do have concerns about the U.S. currency over the long run. And so we have built a portfolio that we add in to the side of or on top of the core investments that we do. And that does have commodities and gold and different types of international and real estate inside of there, trying to create core assets that really hold value if there is a run on the dollar or any other issues that might occur. So that was just some ideas. And I know that you've been looking into lowering risk through the use of maybe buffer type investments.
Sure. This is a very new concept, very innovative, and kind of forward thinking. And so we are an early adopter of these ideas where, again, it's not an exotic strategy. It's just a sophisticated one. And again, doesn't necessarily use leverage or some of the things that are not traditional core strategies. It uses what are called buffers or options in the marketplace. Options have been around and used in different strategies, and there's different ways to use them. But here's very straightforward. What they're designed to do is you own an underlying equity stock basket, for example, so you have equity participation. But what they do, and we use a manager that does this, is they purchase protective options that really protect the downside. So it gives you kind of this downside buffer. So, for example, there's an ETF or a series of ETFs that launch every month. And what they do is say, okay, you own the S&P 500 for your equity basket. You have a 15% buffer on the downside over a 1-year outcome period. And so it buffers that first 15% of downside, and that's really reduces risk. In fact, you see only as it's going throughout the year, you've only seen a lot less risk in those vehicles, a lot less volatility than you would if you're just generally outright owning stocks. Now, on the positive side, you get for that trade-off is, well, they cap the upside, and usually they cap the upside participation at 10%. So it's not a small number, and it'll vary every month. But I'm just giving broad terms, not a specific recommendation, but broad terms of how these work, which is, okay, you participate up to a certain cap. And so they all come out and they all post their buffers and caps every week. And so we monitor this, and it's very innovative. They have been growing, but we find them to be excellent vehicles in this marketplace because you can reduce your risk, again, without using bonds, which what we're concerned about, almost what you're talking about with your diversifier, which is what if traditional ideas are what if there's challenges that haven't been with us historically, for example, with the bond market with low interest rates. Well, what if instead of holding up when stocks go down, what if they go down when stocks go down? And so they defeat the diversification benefits. And so this is a way to add this or a way to have diversification or downside protection and not using bonds, or for that case, when bonds aren't providing that diversification benefit.
Yeah, so we strongly believe that the diversification is the key to investing and making your money last a lifetime. Now, what that means is based on your goals. Let's say your goal is you need more and more income. Our answer is take less risk to reach that income. How do you do that? How do you get the income and still take less risk? By having a core portfolio that is invested in stocks and then diversify more into the income side of our satellites. Now, let's say you're a few years away from retirement and you really want to grow. You want that money you don't want to catch up to a point where you're taking extraordinary risk, but you want to spice it up. Or let's say you're younger and you're just getting started. Absolutely, we need to be designing for growth and investing over time. And the satellite might be more of a part of the portfolio than typically recommended for someone as they get closer to retire. All of this comes together in a financial plan for our clients. All right, Mark DiOrio, this investment portfolio talk is going quickly today, and I do appreciate your time today.
Of course. Anytime, Brian.
Yeah, I appreciate it, Mark. Now, Mark, I know you got to get back to work and talking about investments and managing for us, and I appreciate your time. We also thank all the listeners out there for listening to our show today. So if you'd like more information, you just go to our website, AkersFinancialGroup.com. On that website, you can scroll down into a section where you can set a meeting. Go ahead, you go there and contact us through the website, and that'd be a great way to get started with one of our team of advisors. The other thing you can do on our website is look at that radio tab. The radio tab, you click that, and what you'll see is that all the old shows, the past shows that we've done are right there on the site. You can listen to them anytime. All you need to do is go to our site, AkersFinancialGroup.com, and check us out. We want you to win in your retirement. So we want you to take advantage of this opportunity to work with us at Akers Financial Group. To schedule a free meeting with one of our team of advisors, go exactly to that website, just scroll right down and click and respond to us that way. Or, of course, you can give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We will call you back on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to AkersFinancialGroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Brian Akers of Akers Financial Group is a registered representative offering securities through Kalos Capital Incorporated and investment advisory services through Kalos Management Incorporated. Akers Financial Group is not an affiliate or subsidiary of Kalos Capital or Kalos Management and does not provide tax and legal services. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment.